Hey everyone, welcome back to another episode. Chris Lopez here, and today is the second part in our 7-part series on elevating your flip here in Denver. Now, the title Elevating Your Flip is a play on words here because our guest presenter for the series is Derek Marlin, who is the owner and founder of Elevate, which is a local investment company that focuses on doing a lot of rehab projects around Denver. So today we're actually diving into Derek's deal analyzer spreadsheet. So this is a spreadsheet that he's built for him and his team to use. They work with their own deals, and we'll actually be going through a live deal that they recently sold within the past couple months. So we'll go through all the spreadsheet details plus the key metrics that Derek looks at as he goes out there and analyzes the properties. So Derek, welcome back to the show.
Chris, thanks for having me.
Yeah, so I know we are doing episode number 2 here in a 7-part series.
Yeah.
And as you guys, just so everyone knows, these episodes will build sequentially on here. So this episode ties in very well with the next episode. Today, Derek's going to walk us, and by us, myself included, how he goes out there and analyzes deals, because analyzing fix and flip deals is not my forte. So I'll be asking Derek a bunch of questions that hopefully everyone else out there is thinking themselves. And then the next episode is how to go out there and find deals in Denver. So analyzing deals and finding deals, chicken and the egg, which one goes first, but they go hand in hand. So this one's analyzing deals. The next one is finding deals. So Derek, where do you want to start on going through here with analyzing deals?
Yeah, we thought that we'd quickly just take a look at the Denver market and then get into how we're analyzing these deals. And so really wanting this content to be evergreen, still in definitely a seller's market for us heading into the fall and the winter season. So there's some seasonal normalization. And I think it's going to be really important to look at how our market, for us, we're just calling it normalizes. I don't think that we can keep up this double-digit appreciation every single year, and then all markets are cyclical. So it's looking at still being in a strong seller's market, but for us, it's really focusing on how do you do best-in-class rehabs, meaning quickly, efficiently, both for cost efficiency and for the timing of your projects, and then really put out best-in-class finished products and properties, because you still want to be not only a really great price, but you've got to have a great product to make sure that it sells quickly.
And correct me if I'm wrong, but from a lot of flippers I've talked to, I mean, their attitude is you can flip in any market. You just have to adjust and get your expectations in alignment with the market, right?
Yeah, absolutely. And I think it's also just being patient. So if we're talking about buying deals on market, I feel like there are a fair amount of properties that are out there. The sellers are just taking a little bit of time, and understandably so, for them to come to the realization of where the price might need to be to actually sell a property, especially when it's in, a little bit tougher condition or needs quite a bit of renovation. And so it's being, waiting your turn to get the right deal to make sure that your metrics work and let that catch up, still working with your different off-market opportunities, your networking opportunities, working with your wholesalers, working with other real estate savvy agents to help you find those deals. And just because, again, a good deal that you wait for is far better than, oh gosh, I need to be busy, so let's try to force this and make these numbers work.
Yep. All right. So a couple notes here before we move on. I know, we gave you guys like a 60-second overview of where we're at right now in the Denver market to give you a little bit of context as we go through Derek's deal analyzer spreadsheet. But as you're listening to this recording in the future, I know currently, Derek, you're teaching, I think a couple times a quarter, at least once a quarter, classes here at the Urecastle office with Lon Welsh, where Lon's covering some market data, you're covering some flipping specifics, right? What's the name of that class? Do you recall off the top of your head?
Yeah, so we're actually trying to use this same branding and play on words, and it'll be continued called Elevate Your Flip. And we have an in-class series that we teach, and I'm fortunate enough to teach out with Lon. So you get this fantastic market data of exactly what's going on from a data standpoint in the first half of the class. And then we teach the second half of the class, which is much more of the process and the system of how to flip a property. And then from that, we kind of call that our 101 level class. So whether people are getting into the business and looking to get some general information, or maybe they've done a few things and want to learn a little bit more. It's again kind of that classroom setting. We've now done a handful of classes in the field. So that's our 201 level course. And that's also Elevate Your Flip. And we're doing it at current projects. So that's usually about an hour session where we meet people who want to attend the class at one of our active properties and walk them through our system live and in person. Do some question and answer because I want to not know what people are looking to learn from our class, and then try to address those questions on the back end and have kind of a Q&A and a networking session at the back end. And we do those typically once a month for both of them, and would love to kind of keep up that once a month cadence for each one.
Wonderful. So if you guys are listening or watching this in the future and you want the current market update data, whether it's fix and flip specific or just general Denver data, come to one of those classes. They should be on the Your Castle calendar. They should be on the Denver Investment Real Estate calendar. If you can't find it or are confused, just shoot me or shoot Derek an email. I'll be happy to point you the right direction. Hey, here's upcoming class, or here's recording a podcast we did recently. Something to kind of get you that that current data is what I'm trying to say.
Yeah.
And before we jump into here, this spreadsheet will be a free download that Derek is gracious enough to share with everyone. So we'll either have on the website, and also we'll give some instructions at the end of this episode on how you can get it specifically. And I know Derek will be giving us a high-level overview of the spreadsheet and his key investment metrics. So I know many of you are listening to this while you're, multitasking at work or driving. So we'll do our best to describe all these key metrics and how to use a spreadsheet. But also make sure just to note that this will also be posted as a YouTube video. So if you want the play-by-play, click-by-click description of the spreadsheet, make sure you go to the link in the show notes to download the spreadsheet and also get access to that YouTube video. All right, Derek, I'm looking at my notes here. I think I covered up the initial house cleaning stuff I wanted to cover. Where do you want to jump in? Straight in the spreadsheet, or talk about your investment metrics? Where do you want to start? And talk to me like I'm a ninth grader.
Yeah.
Where do we start when it comes to analyzing fix and flip deals?
Yeah, and I think you brought up a great point. Let's think of it from a 30,000 foot perspective of what are we trying to evaluate, and then we'll be able to go to the actual spreadsheet so that someone driving in their car doesn't have it in front of them, can understand the framework of how we're trying to put this together. So the two things you want to focus on first is we're going to talk about how do you set yourself up for success. That is the price you have to pay for your property, and then what can you sell it for in the back end. So your acquisition price and your ARV price, which stands for after repair value. Those are two super important specific metrics that you look at when you analyze every single property. Then you go down to what are the four key guidelines, or for us, we call them the investment metrics, that define your property that you're looking at as being a good deal. The four areas, which we'll get into in specifics here with the spreadsheet, is ROI, return on investment, the overall net profit that you're making, that's taking into account every bit of rehab costs, the acquisition that you're paying, your carrying cost if you're paying interest, paying closing costs, real estate agent costs on the back end to sell your property, true net profitability, which is super important to keep track of every penny that you're investing on this property. Daily burn, and that's a little bit more of a term that comes from my finance background, but that's really how much are you spending every day. You want to start to look at, you have a good ROI, you might have a good net profit, but if you're having to spend a tremendous amount of money, or again, burning that money, if you will, each day, you need to keep that into consideration. And then the one that we're most actually focused on is called dollars per day. And that is, what is our net profit every single day for how long we hold a property. So that really helps us determine if we've got two properties that we're evaluating side by side, and we decide which one do we want to keep and which one do we want to either let go or maybe sell to another investor in a wholesale capacity, because we can only do so many at any given point. That dollars per day helps us decide, okay, this is going to be something we can get through ideally a little bit quicker. And if you can turn that quicker, you can theoretically, hopefully flip one more property and put some nice profit back in your pocket.
So that dollar per day, that's basically just your net profit, or estimated net profit, divided by total number of days of holding the property.
Correct.
Is that from like close to close, like when you closing on the buy side, then closing to when you sell it?
Yes, that is 100% close to close. And that's the term. I love that. That's exactly what we use, is the day you close, including all of your renovation, putting the property back on the market, how long it takes you to close on the back end. That could be hopefully going under contract in a handful of days. It's staying under contract and getting to the finish line once, or it could be falling out 5 times and it takes you 6 months to do it. It is truly the close to close timeline and how much net profit you're wanting to make based on your initial analysis.
So it seems like this metric is, I guess I'll say, balancing, maximizing your profit while comparing it to your overall hold time to kind of go more of that speed and efficiency.
Yes.
Is that okay? Because I've not heard this term before. So it's an interesting term to me.
Yeah, it really is. And it comes from one of the terms in some of the investment research that we've done or some education that I had done in the past. And that's called the velocity of money. And that's how fast can you turn your money in general. And you can apply that to investment properties. You can apply that to the stock market. You could apply that to something that's in the private equity world, hedge funds, things like that. And that's really how fast can you move your money. And it really originated as we stemmed from doing regular, and for us, kind of traditional rehabs are single family homes, taking, 3 to 4 to 5 months to do the project, investing a little bit more money in the property versus looking at condos and townhomes. If you would only look at that as, oh, what's my ROI or my net profit? And a condo or a townhome is making you $25,000 and you've got a regular traditional flip sitting in front of you that you think you can make $45,000 on. I think a lot of people would say, well, let's go with the 45. But if you can get in and out of a condo and a townhome, and we're going to go over that here in a minute, quicker, your dollars per day are actually far greater. So you could either have 2 condos going on at once and make more money than your one flip, or you could hopefully flip through 2 condos quicker than one flip and truly make more money in a calendar year. And that's where the dollars per day comes from.
Okay, that makes sense. So I want to, before we jump on the spreadsheet here, kind of looping back around to those first 2 bullet points you talked about, which was, the purchase price you get for it, and then your ARV, your after repair value. So you did not mention the 4 metrics you look at that, I'll say that standard rule of thumb in fix and flipping, which is your ARV minus 70% plus fix up cost should equal your purchase price.
Yeah.
Right. I think I said that right.
Yeah. Good point.
And so that's where I've always, from the day one I started looking at real estate investing, I saw that all over Google and lots of podcasts, lots of books. But as I've talked to different investors and flippers up and down the Front Range, a lot of people say they don't go by that rule of thumb just because it's really hard to make those percentages work in our Denver market. Just because if they're trying to take a 30, like, oh, if you do that, you're never going to do a deal. So it's more like we're targeting a certain, $40,000 or $50,000 more of a gross margin. Right. So 2 things. Can you kind of do a better job of explaining that rule and then talk about why you don't look at that? Because I know everyone's seen it out there if they're looking at fix and flips.
Yeah. I mean, everybody really, you're right. It seems to be a moving target. And so most people in the investment world, and this is stuff that I feel like was probably in use 5 to 6 years ago, was still being taught up until 2 to 3 years ago. But
I think it's still being taught today.
Yeah, good point. Probably still being taught today.
And sold today.
And sold today. And that brings up a good point. Really, it's from larger national educators that aren't really savvy to this Denver market. And so your point earlier of you can be successful and flip in every market, even if it is a tighter market to find properties, it's less appreciation, it's homes sitting a little bit longer. If you really refine your business model on, hopefully a monthly or a quarterly or worst case, an annual basis, you can be successful. So I think what a lot of people would define as a good flip was take your ARV, your after repair value, that's your fixed up value of the property. And then I've heard anywhere from, let's call it 68 cents on the dollar to 73 cents on the dollar. You multiply that times your end cost of the house. And then you also subtract the rehab costs off of that. And that's where you should make your offer. I think that's maybe works mathematically, but the reality is you're right. You're going to get beat out on a ton of deals that are still, I think, good deals for people to invest in as far as fix and flips. And then you're going to sit on the sidelines the whole time. Again, it's never to take a bad deal just to have a project to be active on, but it's something that for us, our spreads have compressed a little bit, and that's where that dollar per day metric is super important, because if you can move that money faster, you can still make good returns. It really also, that first way to analyze it does take into account the rehab, but it's a lot more specific if you look at properties that actually don't need as much rehab, and you can still make great profits looking at something that might be a smaller spread when you initially take it at first glance, but could still be a great profit. So I think you have to be a little bit more analytical about it and then realistic within the current market conditions.
And that's kind of what I expected as far as an answer, is just these, I've never been a fan of these general one size fits all rules, because they usually don't fit anyone.
Right.
So that kind of falls in the same category where it sounds good, but not real practical.
Yeah, I agree. I think it's maybe something to start with when you very first start looking into this industry, but quickly I think you can get much more sophisticated without tons of brain damage and get to a more realistic way to evaluate how you want to move forward with the project.
Well, I'm going to be real curious just as we go through whatever example we have. And this is just a thought that popped in my mind, is once you're done with it, I just want to run your property through that simplistic model and just kind of see where it falls.
Yeah, that's good point.
For giggles and fun stuff.
Yeah. Okay. Perfect.
All right. So time to jump in the spreadsheet.
Yeah. Let's go straight to the spreadsheet.
All right. Give us a second here while we transfer over the screens.
Yeah, we'll go straight to, we've got this in Excel. I think that's something that is very commonplace for most people. We used to have it much more sophisticated too, but from not only a teaching perspective, and we're working with clients and showing them how we do this and how we can help them do this, I wanted it from a trainability standpoint for our staff. And then I also want it to be much more applicable market to market as we look to expand outside the Denver market and start flips in other areas. So we kind of made it a little bit more, kind of thought of the Apple philosophy. There's, clean, sleek lines as far as a product. That's what we wanted to do with this spreadsheet. So looking at this, again, we wanted to give people a framework so that you can follow along, and we'll talk through this. Hopefully it makes sense if you're listening in your car versus watching this on the webinar or downloading our YouTube videos. But what we've got is, this is for a specific project that we did. We bought the property in May. We were originally scheduled to finish in late June. Came across kind of the 4th of July holiday, which we can talk about as far as when to list a property. And it was a townhome. So what we do is we enter the information into our spreadsheet as far as the property address, where it is. We like to keep track of our start date and end date. Some of my staff have incentive programs based on finishing projects on time and on budget. So we really need to keep track of that.
So if you edit the start end date, does that count like the total number of calendar days and calculate the dollar per day in your daily burn rate?
It does.
Okay.
Yep, it does.
So that's all auto calculated for you as long as you put good data in.
Correct. Put good data in. You want to put in your numbers of bedrooms and bathrooms. And then also what's really important to us is the square footage. And the square footage, when you enter that, it helps give us a very general cost of rehab. So on average, we were looking at $33 per square foot is what we're spending on average to rehab some of our properties. That is something that we're also in the middle of changing on a constant basis. Also looking at what we have to pay for different types of labor, but that gives you a general napkin math ability to see if a deal is worth looking at more than our initial 5-minute review. So you're able to, on this specific example, it's a bigger property, 2,150 square feet. It was kind of a larger townhome.
That's a big townhome.
It is. It was over in Littleton, Colorado, which is a southern suburb, a little bit larger property. So this would actually be on par with some of our regular flips. But what I like about this one, and this is one of the reasons why we're doing condos and townhomes, is you take typically the roofing out of the play. You take the sewer line repairs out of it because it gets pushed back on HOA. So you have less variables of things to go wrong. But this is something that we look at. It gives you a rehab budget estimate of $70,950. And that's just plainly, how many square feet do we have in this property? Multiplying it times $33 a square foot.
And so that $33 a square foot, you said that's just that's the average of all your flips across all different townhomes, single family homes, and all different square footage.
Correct.
Okay.
Yeah, and we're in the process of breaking out a cost per square foot for townhomes and condos because that's definitely now lower. We hadn't done that in the past, but we started doing those much more frequently in the last 18 months. And then having them for single family homes, our single family number is creeping a little bit closer to the $35 to $40 per square foot for two reasons. One, we're either doing a little bit nicer property, have to put in a little bit nicer quality of work. Labor costs are going up to make sure that you're working with decent contractors that can handle the level of work and the scope of work that we need on our properties. So we're in the middle of kind of splitting those two out. And that just goes back to making sure you're staying on top of current market trends so that you can analyze what is a good deal and what's not a good deal.
Okay.
So then if we're staying we work our way down as far as the analysis, again, look at that purchase price.
So you got this townhome, 3-4 townhome for $289,000.
Yep, exactly. Bought it for $289,000. And then we estimated on the back end what the after repair value is. And ours was putting it on the market at $390,000. So again, if you were to look at it just on a pure spread basis and your general rule of thumb is, I need $100,000 in spread. Well, this cuts it really close. And so maybe you might not evaluate it. But if you're looking at it a little bit closer, you can see this is a pretty decent project. We'll get into how we run our ARV or how we determine our comps on the back end here in future episodes, because that's a whole nother discussion point to look into. But we're really realistic in determining how we determine what our ARV is or what are we selling it for on the back end. And then, so you've got your auto-populated, once you put in your cost per square foot, your total square feet, your purchase price, your after repair value, it gives you a general rehab number. Then what we did is you go through and actually budget and see how much it's truly going to cost. So we enter our rehab budget number. It changes because this was a much more cosmetic job in nature than the $33 per square foot.
So that's the actuals.
This is
what you estimate after you walk through it.
This is what we would typically estimate when we walk through it. This is the end product of how the project actually turned out.
Okay.
So my numbers are a little bit more general on the front end. So back end ARV was $390,000. We typically wouldn't say we're going to sell it for $388,500.
Right.
This was the actual number that we sold it at. Same thing. We budgeted $29,000 as our rehab going in with a contingency, but I wanted it to be, for this discussion, the actual exact property as it stood and how we sold it.
Okay, so these are the actual numbers now, since this is a finished deal.
Correct. This is a finished deal. Yep, exactly. And so once you put in the rehab number, it also generates a contingency amount. So our go-to on most projects is you're looking at anywhere from 5% contingency to 15% contingency budget. And that's based on what your rehab budget is. We typically are always right around 10%. If it's a really cosmetic, smaller property, we'll be in the 8% range. If it's a project where there are some structural issues, we have major systems we're having to fix up, you definitely want to lean towards that 15% contingency to make sure that your overall budget is dialed in. Then we look at those 4 metrics that we talked about in the prior slide. So I'll go in the order of how I think most people evaluate deals. And the first one on this project was, what is the ROI, or your return on investment? Our guidelines are typically, we are looking for 12% to 14% ROI on a per project basis.
So 12 to 14%.
Yep.
Okay.
We want them to be better, but we also want to live in reality. And I'd rather, again, do a little bit more volume. We're not going down to the 4, 5, 6, 7% range, but we think that, and we know from prior experience, that 12 to 14% is a realistic return. Yes, we're lucky from time to time to have, greater returns and really, really phenomenal projects, but we want to kind of talk about the average type of project. And again, we've got our spreadsheet color coded for a green, yellow, and a red. So we want to make sure that all of our metrics are at least yellow, if not green.
Meaning that if it's a negative number, it'll pop up red as like a visual aid.
Correct.
Okay.
And we have those based on our current guidelines. So not even negative per se, but just lower than our standard for return. So we know, do we want to move forward with project A, or do we want to wait and move forward with project B? So we've got, in this instance, we've got 3 yellows and 1 green. So if we talk about our ROI, we went in averaging right around 12%. The end product after we finished it was an 11.19% ROI.
So I kind of want to figure out how you calculate, and your spreadsheet does too. How are you calculating this ROI? I'm trying to read the Excel formula while we're sitting here doing this. I'm not doing very well at it. What's the formula you use to calculate? Is the actual amount of money you're investing? Because as we discussed last week, if you're using a hard money loan with 0% down, you'll get a 200-300% ROI potentially,
right,
versus all cash. So what is your calculation for ROI on here?
Yeah, it's actually the amount of money that you're investing regardless of where you're getting it from. So your ROI is the same in our analysis, whether you're a cash buyer, a hard money buyer, or whether you're doing, let's say, a line of credit, because we want to always do each analysis in an apples to apples fashion. So it's the true amount of money that you're investing, your rehab, your holding costs, your acquisition price, your sales costs, anything like that, for a true ROI versus applying leverage or certain different down payment amounts.
That makes sense. And then it also keeps it more property specific versus lending or flipper specific. Okay, so you're taking the total money all in for purchase, rehab, holding cost, and then profit divided by all that, right?
Correct.
Okay.
Yep. Yeah, we want it on kind of a higher level analysis, because I always like to look back and say, okay, what's my ROI of this versus let's say doing something in the stock market, doing something in the private equity market? Because I think a lot of times people are able to evaluate different ways they can invest their money. And if we start to tweak the numbers based on leverage or based on certain amounts of cash invested, your returns change. And I think it's harder to compare apples to apples versus other things. And then we always really think about, okay, when we're teaching someone, what's the most straightforward? And we really just kind of purely try to look at it on a specific deal by deal basis. How do we determine, is it a good deal or not? And should we keep this one, or should we do 2 of them, or wait for the next round?
Now, I tend, from at least the last 2 minute discussion, this is why I like to analyze things as well, because it gives you a better comparison. So if I'm using hard money, my interest payments will be included in those carrying costs, which will impact the ROI.
Correct.
Okay.
Yep, that's exactly right. So we've got that ability right now. I have typically use a business line of credit, and so we're borrowing at 6.5%. So if we increase that interest rate that we're looking at, it changes your ROI. So if you bump up to 10% and you're borrowing hard money and you're putting in let's say you're paying 2 points up front, that starts to drastically change your returns.
Yeah. So just plugging in those numbers, your profit went from 39 to 36,000 and dropped about 1% down to 10.2.
Yes, exactly.
Okay.
So all these are fluid, and you're able to enter them whether you've got hard money, whether you've got cash, whether you've got a line of credit. This is again just based on kind of how we're currently doing it, but gives you a good sense of kind of different options so that everything can be taken into account. So once you go ROI, then most people look at profit. This is again just your raw net profit. It's every dollar that you've invested minus out every expense you have, gives you your net profit. So this net profit on a townhome that we did in Littleton was $39,096.
So this is the one green box out of your 4 boxes. So what's your range of the net profit you're looking for?
Yeah, so for us on net profit for condos, anything over $35,000 is a green, and that's a good project for us, especially for a condo or for a townhome. Our green for traditional properties is $50,000 for a single family home or single family flip. For net profit, yellow is still good. I mean, 49,000 versus 50,000 is a bit of an arbitrary jump, but it's that kind of that color scale to show you, hey, there's different things you need to be taken into account here.
So
keep an eye on.
is there somewhere in the spreadsheet then, because now that you're talking, different types of properties,
Right.
Can you tell the spreadsheet, hey, this is a condo, so it updates the profit box for that versus single family home?
That's a great point. That's in version 2.0 that we're coming out with, is being able to change that up so you can analyze condos and townhomes as, say, one tab on your spreadsheet versus traditional fix and flips, single family properties as a second one. Right now, we're coming out of this year doing it just in one spreadsheet, but we're definitely looking to update that so we can analyze even more apples to apples of two condos and townhomes versus one another versus two single family flips versus one another.
That makes sense. And of course, once you release that, if you guys are listening or watching this, you'll be able to get a copy of the latest and greatest, I assume, right?
Absolutely.
Okay,
yep,
so
100%.
Net profit for a condo or townhome, 35,000 or greater is green.
Yep.
Single family, 50,000 or greater is green.
Yep.
What's your profit band for yellow on those?
So then we're 25,000 to 35,000 for condos and townhomes. And then we're 40,000 to 50,000 for single family homes and flips. So again, still good projects. Just kind of looking at, let's call it kind of your home run, if you will, versus your good double, for going back to that baseball analogy. And then anything under that, we look at it as red. Not to say that we would never do it, but we really start to be critical and be careful of earning under $25,000 on a condo or a townhome, or earning under $30,000 on a single family flip, because we're pretty confident that we can, through our sourcing networks and hard work, find a project that does fit those metrics. And while we're fortunate to have a good amount of working capital to use, if you commit to doing a project that's under those guidelines, you're potentially passing on something that would definitely be in your yellow range or definitely be in your green range. And you got to be really sensitive to that.
Okay. And you came up with those numbers. Have you had those numbers set from the beginning, or is it just, hey, you've done a bunch of flips now, and now that's where you feel like, hey, that's what we need to see for us to even to go forward with it?
Right. That's a great point. It has evolved over time based on how we have refined the business. They started a little bit lower. It's a function of two things. It's one, a function of me being a one-person show and having no staff or employees to work with that you could technically balance taking a little bit lesser of a deal. It's also what was coming down your pipeline when you're first starting out.
Yeah, okay.
I have a 100%, drop dead metric that I wouldn't go below, because then you're looking at, for example, when I very first started, I wouldn't even consider anything below $15,000 net profit, because 1 or 2 months of holding it a little bit longer, or 1 or 2 unforeseen variables, especially when you're getting experience, you have 100% either worked for free or potentially lost money. So even as a newer investor, I never wanted to make less than $15,000 no matter what the property was. But then it slowly starts to evolve over time based on how much volume can we do. I've got a staff of 2 other full-time associates that work with me in acquisitions and project management. And so we can take a little bit thinner deals, working on volume, looking at these condos and townhomes that I might have actually not looked at in the past. So it 100% has evolved and is more in the line of what we feel like you can run a couple person business off of, with a little bit of volume and scale, versus one person show and what you might need to make to pay your day in and day out bills.
That makes sense. And since we're talking about profit, I want to do that ARV minus 70% rule of thumb. So we had a 388,500 final ARV. Multiply that times 0.7.
Yep.
And so that gives us 272,000 minus rehab of, say, 29,000.
Yep. Mm-hmm.
So according to that, you overpaid.
Yeah, I would.
By the way.
Yeah, exactly. Yeah, I would have had to gotten it for 242. And when could we ever get that deal?
Yeah, I don't. And that's what the numbers came out to, is 242 and change. If you use that rule of thumb, and this is why I wanted to highlight this. So using that rule of thumb, it would have been 242. And Derek bought this for, almost 45,000 higher.
Right.
That 289. So this is why it's very important to, I think, get more nuanced and also be more market specific. So
yeah, that's a great point. And let's say you give your real estate agent that you're working with, who's trying to find you these properties, hey, here's my guidelines. So when you're writing your offers, here's exactly where I need my offer to be. how many offers is it going to take them to have them turn down every single time to have that person probably not work with you again, because every deal doesn't even remotely make sense.
Yeah, more than I'm willing to write.
Absolutely. Yeah, I agree. Yeah, if I give you this, you're going to say, okay, you're going to be nice for a couple, and then after that, you're going to say, oh, something's come up, anything's come up. It's not feasible. And I think if you just told somebody off the street, hey, I'm doing these types of real estate investment projects. It was a flip that I spent $289, put in roughly $32,000. It took me 110 days from close to close, and I made just over $39,000. And it was over 11% return. Is that a decent deal? And they'd say, yeah, that's a pretty good deal. But yeah, you're right. We're $40,000 short on that formula if we use that.
Great. All right. So we got ROI, we got net profit, and then we got your daily burn, right? Is that the next one?
Yep, exactly. Daily burn. And that's how much money are you spending divided by how many days do you have the project. And that one is, again, just to make sure that you're not spending too much. That one really comes into play when you are, and this helps us analyze more expensive projects. So if we're buying a $400,000 or $500,000 home and we're spending $100,000 in rehab, to do that, we need to see significant ROI and profit and dollars per day to make that worthwhile. So it's something that is important. And more so if you're ever doing this, we wanted to think hopefully full circle for people. If they are working with investors and people are lending them money to do fix and flips, a lot of investors are going to want to see, hey, how much of my money are you spending to make this fix and flip profit?
Gotcha.
So we look at that. It's kind of lower on our totem pole, but it's still important. Again, our number one metric is dollars per day. And that's our net profit in this instance, which is just over 39,000, divided by the 110 days that we happen to own this property from the day I closed on it, every bit of rehab, going under contract, and then closing on the back end. This was a 110-day project. And we can change this. When we bought this project, I'm looking back at my notes, we had initially estimated this to be a 90-day project, close to close.
So that, just for the guys can't see it, he typed an update from 110 to 90. That changed $1 per day from, I think, 350 to 447.
Yep.
That went from yellow to green.
Exactly. And this is how we bought the property, is thinking that it would be roughly a 45-day rehab and then 45 days or so to get it under contract and close. And this one, not only with the 4th of July holiday, we ended up going a week longer on rehab than we were initially anticipating. And then it did fall out of contract once. So we had another 10-day hold that we hadn't factored in. Or I shouldn't say didn't factor in, but that you don't necessarily think you're going to see up front when you put a really nice product at a really good price, but it happens.
Yeah.
And so that's when, for us, this is a no-brainer of 2 greens, where if we're making over $400 per day, that's green in our book. And you get that profit over $40,000 and your ROI is really close to being green. So let's say we would have done 2 things: either cut this down to an 80-day project, and then let's say that our profit selling it on the back end was the $390 that we initially thought. Here's our 3 greens. So it's roughly that $100,000 spread, which is one of our current high-level analysis factors on condos and townhomes. Is if we can get a $100,000 spread, it's more than likely going to be a good deal. ROI is over 12%, so that's green. Profit is $42,000, and that's green. And dollars per day is 528, which is really good. So all 3 greens, 100% means go in our world.
And then what? $1,500 less sales price, and holding time was about 20, so 3 weeks longer. So yeah. So it went from 3 greens to 1 green. By the end of the day, you still make profit.
Yeah. So and then it's interesting because we talked about, well, what's your green versus yellow? So the difference of net profit is roughly $2,000, and that took us from all greens in our book to 1 green and 2 yellows. And this goes back to our episode 1 of how do you as an individual investor define what's successful for you? You would just change your color schemes. So if somebody's just starting out and they want to look at, hey, I'm super pumped if I can get through a project in 4 months, I make 20 grand and I make 8% because that's better than I can make in the stock market at today's current climate. They're super happy. Great. That should be 3 greens for you. I think there's got to be, a red to caution people that, again, you could make more money doing other things in certain instances. But It's just resetting your own red, yellow, and green to fit your investment guidelines.
That makes sense.
Yeah. And so you've got your main investment metrics. The other thing that we look at is we also work with clients through our partnership flip program. So that's a revenue share where someone would potentially bring us a property. We work with clients that say that mom and dad are going into an assisted living facility and they don't want to sell their house and leave money on the table. We'll go in, we'll flip it for them. We'll spend our rehab money and do the project for them. We want to show them, okay, if in this instance, we do a 50-50 profit share, they're able to get the $289 that we agree to pay them, the value of the home, plus an extra $20,000. So our spreadsheet is also formulated so that you can look at it as a profit share. You could also, if you've got a partnership and you've got two individuals that are doing this together, you could have, Brian Smith profit, Derek Marlin profit. You could have two different people. You could change it to whatever you want. So our spreadsheet is calculated. So if you're splitting things, we know that there's a lot of contractors out there that are working with investors, and the investor is putting up the money for the house. Sometimes they might put up the money for the rehab. Okay, Mr. Contractor, you do the work. I'll do a 50-50 profit share. That's another scenario where we wanted to be able to give people latitude to kind of use our spreadsheet, hopefully in multiple formats.
So basically, this is just taking your net profit, dividing it by 50%, and saying client gets 50%, Elevate gets 50%, and it's just dividing that number by 2, right?
Yep, exactly. The other thing that we have in here is we have it as a student. You could call it a student. You can call it a client. In certain instances, if folks are borrowing hard money and we wouldn't have to, we would put in, let's say, a point that they're paying up front. It gives you the ability to have the profit share 50-50, but then they are, let's say, paying for their points. So in this example, we just changed our spreadsheet so that Elevation is making 18.7. The client is absorbing their own points, if you will. So they're making 15.917.
Gotcha. So depending on some variables you plug in there, it'll change the profit per client or Elevation.
Exactly. And then the big key is this: how long is it taking you to do your project? That, as you can see, that really changes everything based on your specific guidelines. And then we go down to what are your costs to sell the property, which do factor into your net profit. So selling, from time to time, we'll pay not only a referral fee, but we'll pay a commission. So if a seller feels like they're getting a good deal and a real estate agent brings us a good property, I'm happy to pay a commission to someone separate from closing, so we can enter that cost in so that people are properly compensated.
And that's for the buy side when you're acquiring the property, right?
Correct.
That's what that field is?
Yep, exactly. So that's the buy side. If we're ever paying a commission on the front end, you can populate 1%, any percentage of what you're willing to pay to someone bringing you a property. Because again, we want to be, and we'll dive into this in next episode, but you got to be open to any scenario for somebody to help you find a good deal. Then for us, this is more of the traditional side of things. When you go to sell it, we kind of work on volume. So we're able to sell properties at a little bit of a better price point and working with other clients as well. So our current numbers are that it costs us 4% to sell properties. And that's based on 4% of what your ARV or your sales price point is.
And that's just the commission, right? So 4% of sales price for commission. You've got the other selling costs broken out.
Exactly. Okay. And that one's really important because that's really the way that most folks are working, is you're getting charged a certain commission to sell the property. If you are an investor working with an investor savvy agent, then you can fill in your percentage there. And hopefully as people working with other folks over time, you get a little bit of a volume discount. Or if it's the first time someone's working with another individual, then you're going to pay typically closer to, the traditional fees. But that is, you're right, purely real estate agent commission. And we feel it's important to break out your other sales costs on a little bit more of a line item basis. So property insurance is super important. You obviously have to have vacant property policy when you're flipping. For those folks viewing our screen, my number, we're fortunate that we're a little bit lower because we work with a larger insurance group that we're happy to refer out, but they do a lot of different business for us. So they do a policy over a whole year, and then we just update ours quarterly based on how many projects we flip, and they'll adjust our rates accordingly. So most people are going to be, depending upon how long they hold the project, in anywhere from a $1,500 to a $2,000 policy for about 6 months. Ours is a little bit lower because again, we work on volume.
And so that's really part of your carrying cost
Mhm.
while you're holding it, not like part of the closing cost at selling it, right? So that's your insurance for carrying costs.
Yep,
Okay.
exactly. And then more on the transaction basis, we've got what are our costs when we buy the property. So again, your closing cost to buy and then your closing cost to sell. If it's more of a traditional transaction, many times in our market, the seller is going to pay the closing costs on the buy side. So that number is relatively low. Although we probably, for half of our properties, we offer to pay the closing costs so that the client gets a truly net number to them and knows what their profitability is. So a lot of our projects is we're going to be somewhere in the $1,500 range to buy them on the front end, because I'm sure your listeners who have listened to other episodes know super important thing to take into account is a hold open policy working with your title companies. And that is just your insurance on the small number of days when you own that property. So your costs definitely go down pretty dramatically. So overall, it makes sense to get a good deal. I'm willing to fork over $1,500 on average in this example to pay for the buyer's closing costs, because I know on the back end, it's only going to cost me $300, $400, $500 to sell. We also have a field, especially for condos and townhomes.
So sorry, before you move on to that HOA field, I want to go back to the closing costs, because this is I found a lot of people say closing costs and we have different definitions of it. So when you say closing costs, you're just not talking about the closing cost fee that the title company charges, which is
correct.
$400, $600. You're talking about title policy. Oftentimes, when you say closing costs, kind of what's your definition?
Yeah, that's a great point. So it would be any cost that a title company is going to charge a seller, which is typically 4 to 8 different line items. You're right, not just the one fee, which is typically $300 to $400. It's the document preparation fee, it's the HOA fee, it's the status letter fee, it's the recording fee. It's all those fees that half of us really never know exactly what they're being paid for, what they're being derived from. But at the end of the day, we found that most agents who are representing sellers, or maybe just the sellers themselves, feel that I'm going to pay closing costs as a seller. It's going to be a couple $1,000s all in for all those 6, 7, 8, 9, 10 line items. I know in reality, it's going to be roughly $1,500 on many of our homes. If it's a more expensive home, over $500,000, your all-in costs are going to be $2,000, but I factor that into my offer price.
Oh, so you're finding there's that, I'll say it just from a pure deal making benefit that, hey, you say, hey, I'll pay our closing costs. And a lot of times the sellers are overestimating what it is.
Correct.
And therefore they're getting they think they're getting a better deal out of it, because they're thinking $5,000, $8,000. Like, yeah, it's going to be $1,500, $2,000.
Right.
Okay.
Yeah. And I think it's easier for a seller to do the math to say, okay, what is the amount that I agreed to pay in commissions to whether it's 1 or 2 real estate agents to sell the property? And that math is really simple and they can do that. But I think closing costs are a little bit nebulous from time to time. And
they're a hazy world.
Absolutely. So we just say, hey, let me take that off your plate. For us, many times that could be one of 5 or 6 things. I mean, we did a deal probably about 6 months ago where we said, I'll pay your closing costs. I will pay a professional organizer and downsizer to come in for 2 days to help downsize your property. I'll show up with 2 roll-offs in your front yard and throw all your stuff in there free of charge. And I will put $1,000 towards your moving company. And it helped get us the project, because we're all about how can we solve somebody's problem. And that helps us get a good deal. At the end of the day, whether I paid $289 for the house, or if they would have paid for all those costs and I could have paid $295, the math is the same for me. But it's all about how can we be a problem solver for sellers, whether it's on market or off market. And that's why we have all these variables of how to factor these costs.
Perfect. That was good. Thank you. All right. So going back, before I cut you off, you're talking referral and HOA fees line item.
Yeah. And we feel like kind of the last 2 buckets that we're having to incur some costs on are referral fees. And then in condo and townhome world, definitely you're paying for HOA fees.
Is that the transfer fee or just the monthly HOA?
Both.
Okay.
Both. So it's your transfer fee when you're buying the property, and then it's your monthly fees of what you're paying each month to the HOA. And then anytime there's a referral, that's outside of commissions, traditionally for agents, then we put that in this line item as well. And so in this specific example, even though it was a property that was on the MLS, we had one of our associates that said, hey, I saw this. I think they actually were driving by and they were getting ready to list it. And so they tipped us off to saying this is coming on the market. So even though we found it on the MLS, I paid a referral fee to a client that we work with, and then we paid our HOAs. So that's that line item. And then
for this deal, that was about $1,800.
Mm-hmm. Yep, that was about $1,800. And then our staging and inspection fees. And the way that we break those up are, staging is pretty self-explanatory, but on average, we're paying anywhere from $1,200 to about $2,200 to stage a property. And that includes the fee to our stager and all of the furniture rental. That's typically for month one. You're going to pay moving into month two if you keep that furniture in your property. And then inspection fees for us, that's when I am paying for sewer scope, which we do on every property. If there's structural problems, I'm paying a structural engineer to double check what we feel is going on. So we're anywhere from $300 to $500 of paying structural engineers. So it's kind of this last catch-all bucket, which in this example is $2,300 to pay your stager. In this one, it was straightforward. We didn't have any inspection fees. I should say we had $100, charge for doing a sewer scope.
So even though this was HOA or a condo,
Mm-hmm.
still the sewer scope?
We still did it because it was a more expensive property and we just wanted to triple check. But yeah, most condos and townhomes, we don't do a sewer scope on. But this one, we ended up doing it just to be on the safe side. And for me, $100 is a small cost of doing business to make sure.
Oh yeah, I mean, you don't want a sewer issue coming up on the buyer down the road,
Right.
and you get either it delays it for sure, or you're going to be in the $5,000 to $15,000 ballpark probably.
Yeah, exactly.
So for the inspection stuff, it sounds like, and I'm assuming you're not having a general home inspector come walk the property.
No,
because you guys probably do it with your rehab since you're going to be, tearing down a bunch of stuff and rebuilding it. You're just talking about
Correct.
specifics for sewer scope, structural if you need it.
Mm-hmm.
Do you, for non-HOA properties, do you always bring in a roofer, or how do you check out the roofs?
Probably half and half. Most of the time we're able to do it with our budgeting system. And what we've trained our staff to do is to really look at roofs and know whether we've got to replace them or not. Sometimes when they're on the fence, we'll have a roofer come by and take a look at it. Luckily, we do enough business with subcontractors and certain contractors. They'll just look at it. We don't have a cost. Yeah. Truly, the only thing we actually are usually paying for is a sewer scope or a sewer clean out, and then a structural engineer. Everything else, either we know from our rehab experience or what we teach our clients to look for, or it's those two other buckets that we know we're going to pay for. And, I think some people sometimes say, oh man, I don't want to spend $500 on a sewer scope and a structural engineer. Well, if it saves you from a bad deal, that is pennies on the dollar. Or more importantly, and probably 90% of the properties we buy, even if there's a problem, we still buy them. We just say, here's an engineer that said X, Y, and Z is going on. I still want to buy your property. I just need it for a little bit less. To account for that, we never have sellers make those repairs because that's expensive and it's money we don't want them to spend out of pocket. But even if I burn through that on 10 deals and I spend $5,000, if that saves me from one bad deal, that's still worth every penny. In our
I mean, I think that's a very good investment.
Absolutely.
When you do all that, all that due diligence.
Yeah, absolutely. So yeah, all those kind of costs on the sell side, again, factor into giving you your daily burn, your ROI, your profit, and your dollars per day, which is how we analyze every single property and run through this, probably I'm trying to think of the specific metrics of how many deals we're actually putting through this, but it's, probably on average about 50 or 60 a week that we're putting through this spreadsheet to see if these deals make sense.
So let's talk about that for a minute, because I think you did a great job of walking through the spreadsheet here, the detailed stuff, but going back to the 50, 60 properties a week there, what is your, everything's a funnel. What is your funnel for, because you don't want to spend 3 hours analyzing every or 50 of those properties, and you simply can't.
Correct.
So what's your high level funnel, your quick 3-minute, 5-minute overview, then the next step and the next step type look like?
Yeah, really good question. So our super fast kind of 5-minute napkin math is this worth looking into is for condos and townhomes, there's typically on average $100,000 spread from what we're paying for it on the purchase price to what we're selling it for is the ARV side. So that's our condo and townhome. If there's that, we can, regardless of rehab, we know that's going to get us close enough to look and put it through this deal analyzer.
So 100K spread for condos, townhomes.
Yep, 100K spread, condos and townhomes. And we are at the $140,000 spread for single family homes. And that goes to our sweet spot of the types of properties that we're doing for those, which, to give you a quick overview, on average is roughly a 1,500 to 2,000 square foot home, 3 to 4 bedrooms, and 2 to 3 bathrooms.
Okay.
So it's kind of your home that you see,
it's the standard stuff out there.
Yeah, just your standard stuff. If we have $140,000 spread in that type of property, and the reason for that is we're spending normally $40,000 to about $70,000 in rehab on those projects, that will give us at least 2 or 3 greens, if you will, in our investment metrics. And so that's the really high level of deciding, hey, is it worth, something comes across either my desk or my acquisition manager's desk, 100K spread for the quicker projects, 140K spread for the more involved.
And of course, this is, I forget the exact kind of ballpark price bands you gave, but in the last episode, this is spreads for, I'll say, more affordable houses, not 140K spread on a $1.2 million house in Cherry Creek or Crestmore or something, right? Like, absolutely, you were like around the 500,000-ish mark for single family.
Yeah, for what we're selling it for in the back end, our ARV, we really try to stay below $500,000.
Okay.
And really, our sweet spot is kind of 450 and less. We'll do other projects from time to time. We did one in Englewood that needed $130,000 in rehab, and it was a 5-month project with all the permits. And on that one, there was almost a $280,000 spread. Because you needed more time and more money to make it a good deal.
Okay, so level 1, the funnel is this 3-5-minute glance of 100K spread for condos, townhomes, 140K spread for single family homes. What's level 2? Level
2 is then plugging it into this spreadsheet, and it's still using your buy price and your sell price. It's using that $33 a square foot for rehab to generate what your rehab going to be, and then it's really factoring in how long is it going to take you to do that project. So if you've got those variables, those 4 different data points of buy price, sell price, rehab, and how long it's going to take, then you've got a really good idea of whether this is going to be a decent project.
But this is all still doing it from your office chair.
Correct.
You're not walking the property yet, right?
Correct.
Okay.
Yep. We're not walking it yet.
How long do you think, what's the estimate? How long does it take to do that? To do this second level, just plug in some numbers?
You're probably 10 more minutes.
Okay.
So again, really, really fast. If this really makes sense, then you go and you look at comps and you really double check to make sure that your back end ARV is realistic of what you can sell that property for, and make sure that those numbers 100% make sense. Because this would be something that you would be either writing an offer on, or if it's an off-market property, we would definitely go and book an appointment and see the property in person.
Okay, so do you, I would kind of want to get really nuts and bolts here. So you do the spreadsheet analysis, it looks good. Then do you always spend time diving into comps first before you go walk the property? It's like level 3, dive into comps?
Yes.
And then level 4 is walk the property?
Yes, okay. Correct. Yeah, and I always try to think back of how did we do it when we first got started. We definitely looked at more properties, probably at step 3. Before you would, when it's on an MLS property, we want to get it under contract before we look at it, just to verify that what we see in the pictures, what we get talking from the agent is true. And then we go look at it. But before that, when I was doing it independently and I was a one-man show, we were definitely, or I was looking at more properties before I got under contract than after I got it under contract.
So do you find it, just kind of a side tangent here, do you get any pushback or different feelings from sellers and or the listing agents on getting properties under contract sight unseen? Because I mean, we buy property sight unseen with investors, but also, that there can be two minds of it. If you're the selling agent or the listing agent, I can say, hey, this is an investor.
Yeah,
we're getting a contract sight unseen.
Yeah.
So did you get any pushback or feedback on agents from that?
Yeah, from time to time we do, but we're really upfront with them and just say, hey, if everything that you're telling me is true, or if everything that we see in these pictures is true, then we are 100% interested, and here's the purchase price, and we think we have a deal. So it's almost like we're both developing that level of trust. if there's one picture of the exterior, then we know there's a lot going on in the house, and we're going to have to factor high on the rehab side. And then we just tell them either we'll go out and look at it from time to time if we really think we're close and it's a good deal, but it's just being upfront with one another, not just we are not out to arbitrarily, get 10 houses under contract and stick with one of them and play the game. That's not worth anybody's time. We are 100% really geared towards, hey, we're going to be upfront with you guys. If you're upfront with us, if everything looks good, we're able to proceed. Or if from time to time we think it looks good, we're told it looks good, and then we go out and we find structural problems or the sewer line shot or whatever else. Again, most times we're still interested. We just have to come down in the price. So it's a two-way street.
So something I want to kind of just highlight here is just you're basically just you're having a conversation, a frank conversation, and good communication with the agent.
Yes.
Which is what we find to be one of the most important things for getting deals done, because something I see a lot of times, newer investors just want to blindly submit offers.
Yep.
And there's such an amazing difference of even having a 10-minute conversation with the agent than submitting a offer that's below list price or, more favorable terms to the buyer versus an offer with no conversation. You get such a higher acceptance rate by having that conversation. That basically sounds what you're doing as well.
It absolutely is. And I have a great acquisitions manager, and she is awesome at having a conversation with an agent and saying, here's the range of where we think we're going to come in at. Again, if all things that we can see are realistic. Is this close? We don't want to submit something that is, really lower than you think, lower than the client feels like it should be. And that's okay for both sides. We'll just either keep my information and please call me if something changes. Typically, we're one price cut away, if it's an MLS property, from being right on the money of where we can buy it. So if it makes sense and the agent says, you know what, yeah, my client really does want to sell this, or there's some circumstance that they need to move it, please submit the offer, and we understand why. They can do research on us as a company, that we are honest and reputable. That seems to go a long way. Or we say, keep our number, and then magically 30 days later, a price cut happens and they call us, or hopefully they call us before the price cut. And that's where we want to be a problem solver. Or my really third point is, what else is going on? So do they need help, again, placing mom and dad into a facility to help move this property? Well, we can refer you somebody. Or do you need help moving? Or, what else is going on? We've done almost anything under the sun to help somebody if it's a good deal for all involved. But if I don't know that, or do they need a rent back and they didn't think that was an option? Really anything that we can do, it's just, let's have a conversation, and either it'll work or it won't. It's not, let's, beat our heads against the wall and write a ton of offers.
So I'm not sure if this is dipping into the next episode on finding deals. If it is, we can punt it down there.
Yeah.
But I'm very curious from a high level overview, just the amount of deals you have to put in the funnel to get one deal out. So number of deals and kind of like total time involved. Do you have those off the top of your head, or is that next episode data?
That's next episode data. And it's something that I'm actually really trying to segment out of condo townhome world versus traditional single family world.
Oh, interesting.
So, yeah, let me dive a little bit deeper into that, and we'll have a little bit more specific data on what the sales funnel looks like, because it really is, we're finding that it's becoming different. And one of the reasons why we ended up going this route was actually sitting in a Your Castle class with Lon 2 years ago, and looking at the condo and townhome and true net profit, really starting to adopt that dollars per day metric. And it's been a game changer for us. So we want to look at those separately.
Great.
Yeah.
Okay. So we'll pause that conversation till the next episode.
Yeah.
Because we'll do that. What other things we can talk about in the spreadsheet here? Because I'm looking at all my notes here and I've got everything checked off that I had written down during this conversation.
Yeah. I feel like we definitely have hit everything. It really does boil down to, and I love, that's why we're kind of laying out this 7-part series is, hey, define what's really good for you. Again, you always got to have that stopgap of what's your bare minimum for your time. And then once you've determined that, it's what's a good deal. And then that determines your own personal red, yellow, and green. And then from there, you can really dive in and use a spreadsheet, and I think use it effectively. And I think I got to assume our spreadsheet is going to be a little bit different and a little more refined 2 years from now, as we're looking at different business opportunities, different market conditions. Do we bring a crew? We're considering maybe having an on-staff in-house crew, because right now we hire GCs and subcontractors. That might change our investment dynamics. So we're always changing it. I think everybody else is probably changing, but I think this covers kind of the high level use of how the spreadsheet can hopefully be used by, a huge percentage of the folks out there, whether they're new or whether they're savvy investors.
Great. Well, thank you, Derek. And if you guys need the spreadsheet, you can definitely email us. We can email it to you, or go to denverinvestmentrealestate.com, click on spreadsheets, and there will be a page or a drop-down category on there for the fix and flip spreadsheet. It'll say fix and flip or elevate deal analyzer spreadsheet. I haven't gotten the wording down yet, but if you go there, there's only a handful of spreadsheets, so we'll definitely be able to find it. So reach out to us, go to the website. Is it on your website to download yet?
No, we don't have it to download. We want to kind of roll everything out through you guys first, and then we'll be able to do that and put that on ours. And then a lot of our clients have it when we do one-on-one consulting with clients.
Great. So again, keep it simple. Email us or go to the show notes, and you'll get the link there to the Denver Investment Real Estate website. And I was talking to Derek just a few minutes before we hit record on this, and he's got a bunch of other tabs on the spreadsheet. So if you're watching this recording, it sounds like a lot of these tabs may disappear. And this is more for the project management aspect, which I think we'll be covering in episodes like 5, 6, or 4, 5, and 6 in the series.
Right.
And that's actually converting over to a new tool you're using that's just a better project management, that's more mobile friendly and not tied to a spreadsheet, right?
Yeah, it is. I mean, I think spreadsheets are great, but we're trying to find a way to streamline things so that, again, you can scale, and hopefully we can have multiple people on staff working on this. We're also looking at, here in the next 12 or so months, is to start flipping in other states. We've got apartment complexes in other states and other markets, but we're looking to see how could we truly systematize this process and run it remotely. And so we're going from spreadsheets to a software called money.com, which a lot of people I'm sure are using, but we've put in a lot of time and hours, and we're in probably the home stretch of refining our system and then putting that together in money.com so that it can be used and it's much more replicatable. Yeah, better in the field, better from a software perspective than, I mean, spreadsheets are great, but you can kind of only do so much.
Well, yeah, it's also not real-time updating. If you're in the field, I'm in the office, and we both have spreadsheets, well, then we have a conflict when we both update, save, and send over, and that gets old real fast.
Yeah, it does.
Great. So I just want to point out, because if you see some of those tabs, we're not going through them because that's a future episode, and you may see some of these drop off in the future version 2.0, whatever is coming out from Derek's spreadsheet in the future. All right, so we'll wrap up this episode now. So we still have 5 episodes left in the series, and the next one is going to be actually about discussing about finding deals, which is, I'd say, probably the complimentary one when it comes to analyzing deals. So if you guys have questions, definitely reach out to us. And Derek, thank you so much for spending some of your time with us and sharing your spreadsheet with us.
Absolutely, Chris. Thanks for having me.
All right. Thanks, everyone. Have a great day.